Hello everyone, in this one we're going to cover how I anticipate easy trading days versus hard trading days. As we know, not every trading day is created equal. Let's get into it. So why is it that some days trading is like taking candy from a baby, and on other days you can't win a trade no matter how hard you're trying? The secret is knowing how to use the economic calendar, which flies under the radar of most traders. When I first started trading and I had no idea about economic calendar, timing, price action, it was just, it's 9:30, market's open, let's roll the dice, baby. But what I learned over time was not every trading day is created equal. And some days it's going to be extremely easy to go in there, take your setups and get out. And some days you're going to go in there and you're going to lose an arm or lose a leg. And it's easy to know what days that's going to happen if you understand what I'm about to teach you. In this video, I will show you exactly how to anticipate high and low probability trading sessions so that you can stop blowing accounts and trade on the cleanest days. If you remove these difficult days from your trading and focus on the easiest days, your trading is going to get so much more fluid, a lot easier, and your equity curve is going to thank you. When I first started trading, I had no concept of good days, bad days. It was just, do I have time to sit in front of my laptop? And if I did, you can bet your ass I'm sitting there gambling, like many of you guys right now. It's one thing to know when not to trade, but it's another thing to have the discipline to actually not trade it, right? So this is why you have to have a trading plan as well. Because if you know when not to trade, but you don't have the discipline to avoid it, it's probably because you don't have a plan or you're not sticking to it all the way. Before we even get into the specifics, what are we even doing as ICT traders, right? Before I get into the specifics of high versus low probability, why does this even matter? What are we doing as ICT smart money traders? We are capitalizing on liquidity runs in the market. Regardless of whatever time frame, whatever style of trading you're doing, if you're trading ICT or smart money concepts, you're capitalizing on strategic liquidity runs, which simply means the market running to highs and lows or inefficiencies intraday, in swing trading, or even in position trading. You're doing the same thing. The only thing that changes is the time frame. The market only moves for two reasons, right? There's only two reasons that get us into a trade as a smart money concept trader, which is either repricing to liquidity, we're looking for the market to attack highs or lows, or we're looking for the market to trade into an inefficiency, which is an imbalance in price that the market is going to want to revisit to offer efficient price delivery. You have likely seen that not every day moves easily to these liquidity pools or inefficiencies, right? Not every day it's just a straight line to these levels. Some days it's choppy, consolidation, and not easy to navigate. Let's get into why that is. This is where knowing the difference between high resistance and low resistance comes in. What does this even mean? High resistance liquidity run, or HRLR, is when price does not move quickly, it consolidates, deeply retraces for stops, then eventually reaches your targets. And you're likely to incur many stop outs in this type of price delivery. So it's not that the algorithm's taking a break or it's not working. It's simply certain days aren't going to deliver low resistance, which we'll get to in a moment. It's going to be high resistance, which it's still going to do the same things. It's still going to price in the low of the day at the right time. It's still going to expand to the targets in the market. However, it's going to be done with a lot of give and take, right? Your entry is probably going to have a lot of drawdown. It's probably going to spend a lot of time near your entry and take a long time to get to your take profit. These are the days that are mentally challenging for traders, right? You ever get to the end of the trading day and it feels like you just hit a CrossFit workout, right? And it's usually these days that are going to do that. And these are the specific characteristics that you're going to see in a high resistance liquidity run. There is more to it. There is three specific things that I do measure to scientifically see it's a high resistance liquidity run. But for the most part, this is a good start. The other is a low resistance liquidity run, or LR for short. This is when price moves easily and quickly to our targets with little to no overlapping price action. Easy to trade, right? So when we're in conditions where the market's loose, it's opening, it's dropping, it's quickly repricing the levels we're looking for, this is very easy trading. You're like, sounds great, Dylan. Now, how do I focus on these days and how do I avoid those bad days? I got you covered. How do we determine when we will be presented with a high resistance or a low resistance session? This is where the economic calendar comes in. So we're going to look at this week's trading, Monday through Wednesday. Looking at Monday, before we even look at the charts here, let's look at which days are likely going to be good trading days and which days are going to create poor trading days, or more specifically, the AM session. We see Monday, we have high impact news, flash manufacturing PMI, and flash services PMI. High impact news is exactly what we want to trade. Not every red folder news is the same though. Now let's look at Tuesday. So we've identified Monday as a good trading day. right? There's high impact news, which means there's going to be a lot of volatility. And then going into Tuesday, we now see, what do we have? We had red folder news, yes, but what type of red folder news is this? We have Fed Chair Powell testifying. If you're new to this channel, we have a saying that when the Fed is involved, get out, stay out. When the Fed chair is scheduled to speak, the market makers that control price use it as an opportunity to heavily manipulate price. And it's not going to be easy, low resistance liquidity run trading. These are the days you're more likely to take a bad loss, which leads to 2 to 3, then a blown account. And it can all be avoided if you know how to anticipate and predict these days. Sleep in, take it easy. You're not being lazy. Your account will thank you later. So looking at Tuesday here, we have Fed Chair Powell speaking at 10 a.m. So that's automatically giving us the indication it's going to be a very sloppy morning session. Wednesday, we see the same thing. 10 a.m., Fed Chair Powell scheduled to testify. Now let's look at the respective price action with the economic calendar. So this information in the economic calendar is available months in advance. I already know my trading schedule for July, September, October, November, and December because the economic calendar is consistent. It's out months in advance, so you can schedule your trading day by day, weeks and months ahead of time. So this week, I'm just focused on Monday price action. I'll trade after everything with the Fed chair is over. So you see Monday's price action here, 9:30 to 10:30, that's my sweet spot. It really is 9:30 to 11, but 9:30 to 10:30 is that sweet spot that I really like for the best, easiest trading setups. So looking at Monday here, we see really clean price action, right? Not a lot of overlap, not a lot of consolidation, not a lot of deep retracements. It's just really clean, open, dropping the sell side, expanding higher, really clean price action to work with, right? If we could only focus on these days every day, trading would be pretty easy. You can. Now let's look at Tuesday's price action, right? A lot of give and take, a lot of back and forth, a lot of overlapping candlesticks, a lot of inefficiencies spent a lot of time in. So look at the fair value gaps here. Look how much time it spends inside those gaps. That's the first signal that it's a high resistance liquidity run. Looking at Wednesday here as well, market's a little more loose, not as bad as Tuesday, but not as good as Monday. And you can see a lot of run higher, drop, deep retracements, consolidation, drop, consolidation, deep retracements. Eventually goes to where it's going to go, but it's going to give you a whole lot of trouble getting to those levels. And this is simply put one of the ways that we use the economic calendar to frame these days. So any day with medium to high impact news that's not Fed Chair Powell is going to be a very good trading day because it's going to create the volatility we need for a low resistance liquidity run. The reason it's so impactful is because fundamental traders are trying to make financial decisions based off what this news is saying. So when that news drops, that's causing people to change their sentiment, adjust their sentiment, reaffirm their sentiment with whatever that news is saying. Us, as smart money traders, we don't give a shit about the news. We just care that there is news at that time and that that's going to create volatility for the market to do what it was already going to do anyway. This taught me that my targets do not matter if I'm stopped out 5 times before the market will eventually reach them. When I first started learning about this, I was thinking, well, it doesn't matter. If there's equal highs, equal lows, liquidity, it's time to trade. I'm going to be in there taking trades. But then what would happen is I'd get in, stopped out. Get in, stopped out. Get in, stopped out. And the market goes to my targets at the end of the session. I'm thinking, what the hell just happened here? And I realized it's because I was trading these high resistance liquidity run days. And it doesn't matter how good your targets are. If it stops you out multiple times before even getting there, it doesn't matter. If you reflect on your trading and look at your journal logs and backtesting, you will notice that most of your tilt days with big blowups happen when price action is low probability for your trading style. For my trading style, for ICT price action traders, we need liquidity runs where the market's running to highs and lows or inefficiencies. We want it to be in a low resistance liquidity run because that's going to give us easy entry straight to our targets. But when it is those high resistance days, you're more likely to get stopped out, get chopped up. And if you're not careful, if you don't have a trading plan, you're likely going to go on tilt and then make your weekly donation to whatever funded account company you're trading with at that time. My goal is to help you get out of that cycle and stop donating your money to these funded account companies or having to continue refunding your personal brokerage if you're not being aware of these things. If you lost money in this type of price action, it's not a reflection of your skill. It's really easy to lose money on these days and think, man, I'm the worst trader in the world. I'm never going to get it. Man, trading isn't for me. How long is this going to take? But it's not a reflection of your skill. You're just trading a difficult day. And if you can learn to avoid these days and focus on the easier price action, your stress levels are going to drop. You're going to trade less, but you're going to make a lot more money in the process. Vice versa. If you made money, you likely got lucky. in a high resistance liquidity run, they are tradable if you have a lot of experience, but you have to know how to manage that trading day. High resistance is tradable, right? So don't come at me with pitchforks. I'm not saying nobody can trade these days. I'm not saying nobody can find profitability. If you have experience, if you know what you're doing, you can absolutely trade these days. I'm speaking to the trader that is still inconsistent, that is still not making money, and this is probably why. Now you know one way to predict this. Journal it, learn to recognize it, and avoid being caught off guard the next time. This is how we improve as traders. If you made some mistakes this week, maybe went into some drawdown, it's not the end of the world. Learn from it. That's how I got to this point. Not by being perfect from when I first started, but by taking in the feedback, journaling it, and now you'll see I'm able to focus on the cleanest days because I put in the work, I studied. So now to prove this is not all bullshit and that traders can actually predict this, here's my trading schedule for the week. So for those I'm working with, I do trade live so that you can not only see how the concepts are applied in teachings, but you can also see how they're applied on the right edge of the chart. So if you look at my schedule for this week, trading Monday, avoiding Tuesday, Wednesday, trading Thursday, and Friday. And the reason being is because, again, my trading schedule is centered around the economic calendar. Completely avoiding these days because part of mentoring, part of being coached is also knowing when not to trade and when you're likely going to find more problematic price action. If you want to be ahead of the curve, join our free newsletter to learn how to use the economic calendar to frame the best days to trade every single week. Every week, Sunday, hot off the press, my team writes this, what every trader needs to know, which breaks down the economic calendar, how we're going to use that information to our advantage week to week to avoid low probability and focus on high probability. Hope this one was insightful. See you guys on the next one.